Hi guys, welcome back to the channel, and today we are doing the accounting principles. So let's see what are accounting principles. Accounting principles are the basic rules and guidelines that govern how financial transactions are recorded and reported. So basically there are some rules and regulations we need so that we could record at the transactions and record them and report them in accounting. So by studying these principles, we can apply them. So let's see the reasons we need accounting principles. The first is ensuring consistency in financial reporting across companies and time. So, for example, if you want to compare two companies and their reports are in a completely different way, it would be really difficult for us to compare them. So, it's really important the accounting reports are consistent so that it's really easy for us to compare reports from different years or different accounting companies. Other is to build reliability so that financial statements reflect true business performance. So if I record my business in a different way to somebody else, so maybe I miss something because that's based solely based on my experience or the way I want to. So I can't truly reflect the business performance. So that's one of the reasons we need accounting principles. The third one is to promote transparency and helping stakeholders trust financial information. So, if all the information I mentioned in the report is made by myself, so maybe I'm not transparent about some things which might have a negative effect on my business. So, I have to follow some rules so that transparency could be there. Also, if there's a standard of maintaining the records, stakeholders like the creditors, uh, the bank people, your customers, it would be really easy for them to identify, like, oh, this is being missed. It means there's something odd in it. So it's one of the things which help these stakeholders trust your financial information. Next is support decision making, providing accurate data. So since if we follow the principles, it means that the data would be accurate because it's according to the rules. So it would be really easy for us to make decision making. Other is ensure legal compliance with financial reporting regulations. So based on the country you are in, there would be some regulations based on which there's some legal things happening. For example, if I open a company, you would know there's so many legal stuff to do to convert a company from sole proprietor to selling shares. So if your accounts are proper, the process will be really easy for you. But if it's not, you would be in a really big trouble. So accounting principles are really important. The other one is preventing manipulation of financial results. For example, if you don't do any issues with your books, but your accountant does, it would be really easy for you to identify if there are any discrepancies in that. So it's really difficult to manipulate data because there's a standard and you have to follow it. If it's out of that, it means there's something wrong with the data. Also, the reason we want accounting principles is for financial statements. So let's see who needs the financial statements is the reason we're having these accounting principles. So first of all is the business. To maintain accurate financial records and reports, we have already discussed it in the previous slide. Accountants to prepare and audit financial statements. Accountants' jobs are to prepare the statements and also audit them. For the people who don't know what auditing is basically just cross-checking the financial information on in the financial statements just to see that there's no discrepancies or there's no frauds or manipulations. So cross-checking it that everything is correct is auditing. So we need to have that up to the mark so that auditing is easy for the auditors and it's really easy for the accountants to prepare the financial statements. Then next we have is the investors. To access a company's financial health and make informed investment decisions. So if any investor wants to see that how much return they would get, they could easily see the financial statement and get an idea of would they like to invest or not. Next is lenders. To evaluate a business ability to repay loans. So when you go to buy a loan, you show them that this is the thing you would keep at stake for the loan. So if the if the bank feels like, oh, the company has good amounts of assets in case they don't pay the loan back, we can possess them. So it's really easy for lenders to know that if the company is in a position to pay back loans. Regulators to ensure companies can comply with financial laws and standards. So if you check the financial position, it will be really easy for the regulators to know if they're complying with laws and standards or not, managers to make informed business decisions based on financial data, auditors to verify the accuracy and fairness of the financial reports. So, the first accounting principle is the business entity principle. So, it says that the business and the firm are separate from each other. So, it means that even though the sole proprietor is the one whose money and assets are invested in the business, still the personal expenses of the entrepreneur would not be recorded in the business books. So let's look at the application for that. This principle is applied by maintaining distinct financial records for the business, keeping all personal expenses of the owner out of the company's accounts. So this is what we have discussed. So let's look at the example to understand it a bit better. Suppose Sarah owns a bakery. If she withdraws 500 from her personal savings to pay her rent, it would not be recorded in the bakery's financial records. However, if she withdraws 500 from the business account to buy baking supplies, that transaction will be recorded in the bakery's accounts as a business expense. So if Sarah is paying her own rent, like her home rent, using her personal savings, even though she's a sole proprietor, that wouldn't be recorded in the business bank. But if she uses money of the business account to pay for the baking supplies, she has to enter it as a business expense. Also, if she uses business money to pay her account, her rent, still that would be recorded as drawings in the books. Next is the money measurement principle. Only transactions that can be measured in money are recorded in financial statements, while non-monetary factors like employee morale are not recorded. So for every success of the business, we need monetary and non-monetary data. So if employee morale or employee motivation isn't there, it would be really difficult for the business to work. But we only record monetary transactions in that. So employee motivation or employee morale are not recorded in that. Let's see the application. Business record measurable items like sales, expenses, and assets, but exclude non quantifiable elements like brand reputation. Example, a $10,000 machinery purchase is recorded, but employee dedication is not, since it can be expressed in monetary terms. Let's look at going concern principle. It assumes that a business will continue operating for the foreseeable future without plans to liquidate or significantly downsize. So, whenever we report our accounting data, we always keep in mind that the business is going to continue and it's not going to close soon. So, our accounting should be on the base of that. Let's see the application. Assets are recorded at their original cost without assets are recorded at their original cost rather than liquidation value, assuming the business will continue to use them in long term. Liabilities and long term investments are also handled with expectation of ongoing operations. So let's look at the example to understand it a bit better. A company purchases equipment for $50,000 and records it as a long term asset, depreciating it over several years, assuming the business will keep operating and using the equipment. So if you've seen my previous video on depreciation, you would know there's so many methods of depreciating an equipment. So when we depreciate an equipment, we want to use the equipment for the complete life of the asset. So we don't assume that the business is going to close after 5 years. So we should only use it for 5 years. We do the depreciation based on the life of the machinery, assuming that the business will continue perpetually. So we do accounting in that way. So next one is the historical cost principle. This principle states that assets should be recorded on the financial statements at their original purchase price rather than their current market value. This ensures objectivity and reliability in financial reporting. So let's see the application of this. Business records assets such as property or equipment at the price they paid for them, even if the market value changes over time. For example, you bought a property and the prices increase in a week. Even though the prices have increased, you wouldn't increase or decrease the price of the land or equipment or whatsoever you have purchased in your books. If you purchase a machinery for $10,000, you have to keep the price of the machinery $10,000. Doesn't matter if there's a discount to it and the prices have reduced, or there's a shortage of the product and the prices have risen. You have to keep the amount the same at which you have purchased it in your books. Let's look at an example. If a company buys land for $100,000, it will continue to report the value on its balance sheet, even if the land's market value increases to $150,000. Next is the materiality principle. It states that financial statements should include all information that will influence the decisions of users. Information is considered material if its omission or misstatement could affect the economic decisions of users. So there's a really easy way of remembering materiality principle. For example, if you work in a bakery and you purchase a pen, even though you're using pen for recording your records or maintaining some data, you wouldn't record pen as the asset of the business, but you would record Evan as the asset. So having making small purchases which are like just for $1 or $2 or $5 wouldn't be an issue for the business, but purchasing like something like for $10,000 is really important for the business. So minor stuff has to be not recorded, but of course the major stuff has to. Let's look at the application example for it. Companies must assess which financial information is significant enough to be reported. Minor transactions may be aggregated or excluded if they do not impact the overall financial picture. For example, if a company purchases a small office supply item for $10, it may choose to not report this expense separately because it is not significant enough to influence financial decisions. However, a $10,000 equipment purchase would be reported due to its potential impact. Duality principle. This principle is also called as dual aspect concept. So what it states that every financial transaction has two equal and opposite effects on the accounting equation. For example, when you go and put any entry in accounts, it has two effects to it. If something is debit, of course, something has to be credit. So if you're putting a debit entry, you have to put a credit entry somewhere. For example, if a company takes out a $5,000 loan, it receives cash, which increases assets, and incurs a liability, which is a loan payable in this case. So assets increase by 5,000, which is the debit side. Liabilities increase by 5,000, which is the credit side. So we have put entry on the debit side and also the credit side for the same transaction. Next is consistency. The consistency principle requires that business use the same accounting methods and practices from one period to the next. This ensures comparability of financial statements over time. For example, a company adopts an accounting method such as a specific way of depreciating assets. It should continue to use the method unless a justified reason for changes exists. You would have seen in my last video that there are three ways of recording depreciation for your asset. So if you're using a straight line method, you suddenly in the next year can change it to reducing balance method. You have to be really consistent in the way you're using it. So try to keep it same unless and until there is a really justifiable reason that you have to change it. Then of course you can change it, but you should try to be as consistent as possible because it ensures that it's really easy for anyone to compare your financial statements over time. Next is the matching principle. This requires that expenses be recorded in the same period as the revenues they help generate. This ensures accurate reporting of profit by matching related costs and revenues within the same period. Application. Businesses must link expenses directly to the revenue they contribute to. Now, let's look at the example to understand a bit better. A company sells goods in December but purchases goods in November. The cost of the goods should be recorded in December, but the same period the revenue is from the sale is recognized. For example, if you have to pay a rent, for example, you own a company and you pay the rent for that place, for example, $5,000. For some reason, you couldn't pay the rent in December and books close in December. So what you would do is, even though you have not paid the rent for December, you would show it in your book saying that the rent is payable It doesn't matter if you pay it the next year, but still you have to show all the information, even if it's to be paid or to be received for that financial year, even though you pay cash or receive cash after your books are closed. Next is the realization principle. You could also name it the revenue recognition principle. States that revenue should only be recorded when it's earned, regardless of when the cash is received. This typically happens when goods or services are delivered, not when the payment is made. So this is quite similar to what we did in the last um, slide, which is the matching principles. So they're pretty much the same. Let's look at the prudence principle. It states that accountants should exercise caution and avoid overestimating income or assets. Losses should be recognized as soon as they're foreseeable, while gains should be only recorded when they're realized. Let's see the application. Businesses should not overstate assets or profits if there is uncertainty. Potential losses should be accounted for immediately, but potential gains should be only recorded when they're certain. So, if the business feels like there's a loss coming up, you should definitely record it in your books. But if you feel a gain is coming up, you should be really reluctant in that and only enter it when you're 100% certain that's going to happen. Let's look at the example. If a company expects a $10,000 lawsuit settlement but has received it yet, it shouldn't record the income. However, if there's a chance that the company will use $5,000 in a different lawsuit, it should recognize this potential loss immediately. So this was up, guys. So I hope you liked the video. If I will have any questions about all the 10 principles, please don't hesitate to ask me in the comment section below. And if you like this video, don't forget to subscribe the channel, like the video, and comment it. Thank you so much. You have a great day.